Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Jonathan Barratt, CIO at PROBIS Securities, joining in. Jonathan, always a pleasure to have you and speak to you. A very warm welcome as well. Let's start with the kind of announcement the FOMC came out with as well. Clearly, if you go to see, they've said that they don't plan to increase rates right now or cut. They are going to maintain them and let them remain stable. Uh, Overall, what do you actually make of the decision that they've taken?
Yeah, look, I think it's a very interesting decision. We do have price pressures to the top side. We do have those inflationary pressures starting to come in. The FOMC or the Fed knows they can't increase rates because that's going to be detrimental to return to the market. I do feel that the Fed statement concerning taxes and the delayed of taxes is one method, but I do also feel that we might get something similar to an Operation Twist to reduce monetary surpluses when it comes to that. So at the moment, yeah, quite a statement there. Steady as she goes. Dow goes to record highs, stays at those levels. But once again, we have to question: is it sustainable?
Absolutely. So clearly, if you go to see, they've said near zero interest rates at least through 2023.
Mm.
However, they've upgraded their economic outlook to reflect greater optimism over the US recovery from COVID 19. Now,
Mm.
when you talk about a moderation in the pace of the recovery, and if you see the indicators of economic activity and employment, they have turned up recently. However, the sectors most adversely affected by the pandemic still remain weak. So, if you have to take a holistic view, do you think this is a trend that is expected to continue, or is this just a pent up demand, or is it just because of a low base we are seeing this kind of a up move?
Mm. Look, I think the up move we've had, I mean, if we take the COVID situation and we see the vacuum that it created, now we're seeing a lot of stimulus which is now pushed in, and that stimulus is starting to gain a lot of momentum in terms of price pressures as well. So I mean, holistically, we can say, yes, we've got a problem. Yes, we're trying to solve it. We have a vaccine. Yes, we're going to solve it with this vaccine. It's all going to be good. So therefore, the economy should be great after that. Agreed 100%. But when you do look at the amount of stimulus in the economy, one
Mhm.
has to question what will that then the amount to be how will that be portrayed in demand and in the recovery? And I think that's some of the pressures that we're finding at the moment.
Right. So, overall, Jonathan, the massive fiscal support, the widening vaccinations, do you think they will help reopen the economy? And that's something that actually buoyed investors' expectations for a rate increase and inflation. And because of which we did see treasury yields, which went higher.
Look, I think that's what we're seeing. This is the crux of the matter. It's sort of you can you have the stimulus? Can you have this program continuing without having price pressures, without seeing those yields start to increase? And this is where I think the Fed will have to become a lot smarter in terms of how it says, well, let's keep the long bond, sort of where it is, but let's put the short end up a little bit so we don't actually affect real rates of return. And I think that to me is where they have to really be smart because, we don't know, or we do know that if we do have a turn and a second bout, second round of infections, how will the market address to that? Well, the market will say more vaccines, more vaccines. And then I think that's the thing that the market's sort of looking at and saying, well, the panacea is the vaccine. If that is the panacea, then everything should be okay. And then the government stimulus policies, can start to taper off. But at the moment, they're right on target. They're trying to do as much as they can. And as a result of that, we should see that short-term yields start to pick up.
Right. So clearly, are we trying to say that the 10-year treasury yields, they've started easing from the recent highs after Fed and Powell reinforced their dovish stance, right? So
Mm.
what's the kind of trend are you expecting from here on the 10-year treasury? Because
Mm.
clearly, if you go to see, there is a lot of liquidity in the system. And if you see in terms of the GDP, they've projected it to grow by around 6.5% in 2021.
Yeah. Look, I think given the Fed's statement and what the market says and what the Fed do are different. They try to follow a good path, but that's what happens. You can see that yields sort of start to soften in given the rhetoric that we've seen. But at the end of the day, you still got to be looking at all that stimulus which has been pushed into the market. Now, you can't have one without the other. And I think that's the concern. And I think you'll find that Powell will come out and continue to say that this is what he's going to do. And then we'll find those yields to be softer. And of course, that's what they want. But the true economics of it, when you see oil prices, starting to move higher, commodity prices starting to move higher across the board, how does that filter into the economy if it doesn't affect the return, that companies will experience with higher inputs? And I think that's one of the big concerns.
Right. And with the quantum of liquidity that's being infused, especially with regards to where US goes, do you think that's something which could be a positive for emerging markets as well?
Look, I think it's got to be a positive. You've got to see it. You've got to read it as a positive, because I think at the end of the day, you know, when we see this stimulus going through, it's got to filter down through the economies. And to me, that's one of the most important things to see. And if you see commodities start to pick up, then you see confidence start to pick up. You start to see return pick up. And when I start to see that, I get more confident that the global economy will start to achieve the rates of return that it needs to in order to get over this whole COVID issue that we've been experiencing for the last 18 months.
Right. And with this, how does it bode with regards to gold and silver? Because clearly the anticipation is that till the time the Fed says that the loose monetary policy is something that will continue, do you think the momentum for gold and silver will also continue on the back of the same?
Well, I think the interesting thing with gold and silver, and there's two parts that I look at, is that the gold is that store of value which we love. That's the store of value which we think if we start to get that price pressures to the top side or instability, we go to it. Gold has been correcting for some time. Last night, on the back of what the Fed have come out and said, we saw a reasonable spike in gold, up back through that 1750. So I'm actually starting to think that gold will have a bit more of a run to the top side from here. And it's also getting into some very technical areas which suggest that we will see gold start to trade higher. When I look at silver, it still should keep pace with gold, but I think silver has been the one that's moved the most, hence that gold-silver ratio being on record lows. But I do expect gold to start to pick up a little bit of value, break through technical levels, and up it goes. Given what the Fed has said, given what the dollar has done, the US dollar has done, that all bodes well for this gold trade to pick up momentum and eventually see it back up through that 1800 as an ounce.
Right. And overall, Jonathan, with this, very rarely we've seen a rally that's come through in equity as well as in terms of where gold goes. Now, clearly, do you see any fundamentals because of which we're seeing a rally in both these asset classes?
Well, I think when I look at gold and I can see the rally in gold that we're seeing, then I see some of the asset prices sort of in some of the stocks which haven't actually moved in gold as well. I see that there's this chance for this rally in the metal to gain momentum. Will we see commodities start to gain momentum in terms of the price, in terms of moving higher? Yes, I still see that. A lot of people are talking about this the commodity rally, the super cycle, and that we're starting to continue to move. Gold will keep pace with this. So I think asset values, should start to continue to move higher if in fact we keep this stimulus here. Now, we've seen a lot of prices in terms of real estate, particularly in Australia, having to move quite tremendously higher for some reason, for that pent up demand. So I think generally asset prices remain relatively stable, and I'll see more demand for asset prices whilst interest rates stay at these lower levels.
Right. So would you advise someone to look at gold and silver at current levels?
Oh, look, I can't see. Yes, I would. I would think that within your portfolio, if you don't have it, I would recommend that you do have it. I think that when you look at where the US dollar is and what the US dollar should do, when you look at gold and how it's corrected, back for some very good levels, it has done in a very technical manner as well. I would suggest that people would start to look at gold. people often ask me, when do you buy? When's the right time? I always say, well, look, I've always got some gold that I have, but would I be acting just a little bit more at the moment? Yes, I would be. I think we're coming to some very interesting technical levels, particularly above through that 1760 level. And if those areas go, then we can see that test a lot higher. So if I were wanting to invest in gold, I think you can see at these levels, you've got some very good reasoning to all the macros, the reasoning behind it suggesting we should go in it. We should start to move higher. But I also think the technical story is also pulling the gold price higher. So based on those two things, yes, I think it's probably not a bad time to buy gold at these levels.
Right. And then with this, we know that the government has been accumulating debt in the US. The US dollar is a very interesting topic at the moment. And if you see the performance again right now, it's depressed almost near a 2-week low. The momentum has recovered, but you still do see some bit of weakness. Do you think the bulls need to cross levels of 92 to retake control? Or how do you see that entire movement happening?
Well, I think when I look at the US dollar, excuse me, sorry about that. I do think that the US needs to see the dollar generally weaker. If the US want to focus on the US retaining growth, which then hopefully will pull up the whole economy, then if they've got that ability to export a lot easier via a weaker US dollar, then that should turn that economy around a lot quicker. And with that turnaround a lot quicker, everything else should start to move higher. So I think the general rhetoric we'll have will be for the US dollar to be weaker. And as a result of that, that will help sort of some of our gold trades and certain other things. But generally speaking, the dollar has been weak, and I think the dollar will remain weak for some time.
Right. And then with this, if you see with regards to where the European markets are concerned, you have Britain, which has come out and said that Britain's economic activity will return to its pre-coronavirus levels at the end of the year. And this is mainly back on the vaccine rollouts. And early 2022 is what they're looking at, where with regards to where the interest rate decisions go as well, which will be coming out today. What's your anticipation on that front?
What, in terms of the global economy coming back to normal? Look, I think that's a hard question because, when you look at the forecast, we can project that you continue to throw, a lot of band-aids at an issue, and I think that'll work. The question is the amount of money that's being printed from the Fed, and how do you rein that in, or how do you get that ability to repay it? Now, there was a very interesting article that was put together by Summers, and he actually said that it's not the ability of the size of the debt, but how we actually repay the debt, the servicing. And I think that rhetoric in the States has taken hold. And as a result of that, it's more about how they service their large debt rather than actually have the debt. That has consequences on it, and that has consequences to the market. But at the moment, the market's not seeing that. The market's saying, well, look, if you can service this debt while keeping interest rates very low, then it's just an ability for the economy to perform. And if the economy performs, it'll pay down the interest and it'll also pay back the debt. And I think that's what they're looking at. But the sheer size of this, I think, is a concern. And we know that if you continue to print debt, there's got to be some consequences as a result of that. We haven't seen those consequences yet. And as a result of that, it's very hard for us to turn around and say, well, we feel that by the beginning of 2022, everything will be right and rosy again. I think it's very hard to say that that is the case and will be the case. And I think that given the imponderables that we're dealing with at the moment, it'd be nice to be at a starting point to 22 to where we were, say, in 2019, 2000, before all this happened. But I think it's very hard to conclusively say that.
Right. So would you say that the Bank of England has been caught in a phase of uncertainty because you have questions over Brexit leading to a degree of hesitancy over committing to any particular direction for the monetary policy? So clearly, do you think the BOE's focus should now shift away from loosening and towards a potential tightening?
Oh, look, I think when people often question me about Brexit and all that, I just think there's a lot of money that's been wasted, a lot of problems, a lot of concerns. Look, I think the focus on driving the economy higher, has to be the right mix of fiscal and monetary mix. The Bank of England, prudentially, they've always managed the economy very well. There's no doubt about that. This change is a big change with COVID. There are still many things that they have to take into consideration. But I think at the end of the day, being separated from Europe will give that sense of value back to the UK. And as a result of that, those deals will sort of see the economy. So in terms of the focus, I think they've got to continue to have that mix. But generally, I think central bank focus around the world is trying to keep that loose monetary policy as much as possible in order to get those economies to start to grow and ratchet higher on their own momentum and not stimulus.
Right. And then with this, what's the kind of impact are you expecting with regards to where crude goes? Because we've again started moving higher. Do you think $100 a barrel is going to be like a cakewalk, or do you think that's not levels that we should be watching out for?
Very, very tricky question, because we've got levers in the market at the moment which could be turned on at any time. OPEC Plus in the last OPEC meeting have said that, well, look, we're happy with it. So we've got that supply. We can always add supply. I think the question we have to ask ourselves is what levels or what range are OPEC happy with at the moment? 55 we know is too cheap. Is 75 too expensive and they'll make the return that they need? I tend to think that the 55 to 75 is a range. Outside that range, we start to get persuasion, whether it's OPEC or whether it's the consumers. But what I do feel at the moment is that there's a higher propensity for the oil market to start to trade higher. Now, when I look at that, I think US $85, a barrel is a very high level. But given where we are at the moment with stimulus, coming into summer demand, coming into the fact that the US went through that concern about supply, a month ago, I get that sense that we are ready for crude prices to move higher to the top end. As to whether or not they stay there is a different thing. But at the moment, I feel that given where we are, prices can go through US 75, maybe even US 85 in the next couple of quarters. But I don't think it'll stay there.
Right. And then with this now, if you shift focus to the emerging markets as well, do you think that the kind of recovery that we've seen across Asia's emerging economies would actually withstand the rising US yields, say, so long as it reflects an improving growth outlook and reflation rather than a monetary shock?
I think when we look at those, the emerging economies over the developed economies, I think we've really got to see, when you look at what's happening in China, we just have to look at example there for the iron ore, what's happened there. Iron ore markets were squeezed, but return and economics numbers haven't been as positive as what we thought they would be. And as a result of that, we're seeing, that demand for iron ore start to come lower again. So when I look at the developing economies, yes, we need the developed economies to help, and those to then add to those developing economies to continue to follow suit. But I do think that, whether we're talking developed or developing economies, it's that price pressure which worries me across the board, because if prices go up, margins get squeezed and returns get low. And that, to me, across the board is the problem.
Right. So within emerging markets, if you have to look at India, where would you place us? Because clearly, if you go to see, there have been concerns over high valuations with the way equity markets are moving in India. How would you place India right now?
Look, I think when I look at it, we've got concerns in terms of oil moving higher. I see India as an economy, which has the right levers to be able to adjust both monetary and fiscal policies. I do think, like any market, equity prices are too high. But what I do think that if they are too high, then when will they turn? We don't know yet. But I'd always be cautious, because everyone's done well out of the rallies in equity prices. Is it sustainable? Well, the global economies, are they sustainable? That's the question you have to ask yourself. If that is the case, India will go well. I do think that India might have some issues with the crude market, right? Moving higher, which might sort of level off those equity prices, particularly in the oil sector. So if I'm feeling that oil is going up, yes, we know that's a problem for India. But at the end of the day, I think most Indians have some gold, so hopefully they'll make some return back on that.
Right. Now, one thing is that all this while, in spite of COVID, you have FIs which have continued to remain investors with regards to where Indian markets are concerned. Clearly, from here on, God forbid if this is actually a second wave and things worsen with regards to COVID in India, do you think FIs will start profit booking and withdrawing from the Indian markets?
Look, I think that it's a possibility for anyone to take profit. Okay. The key is whether you're taking profit and whether that profit becomes a trend for the market. I think you have to look at the reasons why they start to take that profit. And then you have to be pretty nimble on your feet to look at it. I mean, in any market, that's a situation we face with. That's why we're in the markets, for those, whether we see it, we've got opportunity to make money and to lose money. But I think the general play for global equities, if the federal governments, if the monetary policies all interact to work, well, then we can see those returns. But I have an option. I have a cautiousness around a lot of these, because if we can't contain those bond yields correctly, then we will have problems, because by moving interest rates just by 1%, that's 100% increase in your cost of money. So as a result of that, that's got to have dire consequences throughout the economy. So if they can't, the caveat is, if they can't control the price pressures through the economy, interest rates or monetary policy has to tighten. If that has to tighten, then we can see equity prices and asset bubbles start to deflate.
Right. So if you have to be an investor right now in terms of emerging markets, what percentage of your portfolio would be you be ready to allocate to India in the equity markets, and what kind of sectors would you prefer?
Look, I think when you look at it, you have to have a balanced approach to any portfolio, you know, and we a lot of investors sort of say, well, okay, we're in the US, and there's always a heavy weighting there. Then we've got some of the specky countries like Australia, which people like for safety. You know, Japan also has had a terrific run. You know, when I look at India, it is that part. It's such an important economy, you know, in terms of what it delivers to the global economics, that you have to have some weighting to it. So there has to be that exposure, just like any of the other equities. When I do look at it, you know, it's that technology sector in India, which is the real driver. So although asset prices are relatively high in that phase, I like the technology sector there. And I think everyone likes the technology sector, because let's face it, everyone wants to try and find a unicorn eventually where they can make a lot of money.
Right. And amongst asset classes as well, which would your preferred bets be if you have to look at gold, silver, if you have to look at crude, equity, as well as base metals?
I think that base metals have had an enormously good run. You know, when you look at your coppers, your zincs, everyone's had a very good run there. When you look at your base metals, you know, is it time for turning there? Whilst we have these stimulus programs, no, they're still looking quite good. If the stimulus starts to turn off, then you'll see base metals start to come up under pressure. You know, when you look at, you know, gold, that is one market that hasn't shined over the last whilst all the other asset classes have. And sort of I'm looking at that, you know, and I think gold is good. Only last 2 weeks ago, we started to move into some of that mining sector, the gold producing sector, because we feel those miners that haven't forward sold yet will be the ones that will have the biggest push, seeing that we're hopefully going to get that push in gold over the next quarter. So I think I would be weighting myself less to financials, but more into the producers, gold producers at the moment. And that's what we've done.
Right. And are you expecting some bit of a correction to come through, especially with regards to equity markets?
Look, I think that there's always that chance, you know, when you see markets on these highs, and honestly, I'd like a dollar for every time I've tried to short the S&P and the Dow, you know, because it just keeps going and the market likes it. You know, so you know, people have made an enormous amount of money where perhaps they shouldn't have, but that's just through the market being manipulated by that fiscal policy and monetary policies to enable stimulus to occur. There should be a correction at some stage. How hard is it to point that top and pick the top? It's very hard. But I think we'll see if it's not contained by the governments, the feds, then we'll see that crack. So I think once you do see it, you'll see a large move, and then you'll probably see larger moves after it.
Absolutely. I think that's something we should be watching out for. Thank you, Jonathan, so much for joining us on the show. As always, a pleasure to speak to you. Stay safe and hope to speak to you soon again.
Thanks a lot, and good luck to you as well. Bye-bye.
Thanks. Bye.